Welcome to Colliers' 18th Annual Commercial Real Estate Outlook Conference. I'm Jim Shipman, Managing Partner and Designated Broker at Colliers here in Idaho. This is, as I mentioned, our 18th conference, started years ago by George Iliff. It's a great tradition that we have, sharing insights on what's been happening, where we are now, and our outlook for where we're headed in the commercial real estate industry in the state of Idaho and throughout the Northwest region. We're excited to have you all here today. We've got a great group. We've got Dr. Michael Wilkerson, Carolyn Holly, and then a panel of our own Colliers experts that will be sharing their insights on the market. First, a few thank yous before we get started. I want to thank, first of all, as everybody knows, we're in our 20th month now of this pandemic, and we've all worked hard and struggled through, but nobody more so than our healthcare workers. So I want to have a special thanks to all the healthcare workers here in Boise, the Treasure Valley, the state of Idaho, and throughout the country for their efforts in helping us get through this. Also to all first responders around the country. As many of you know, we had a tragic incident on Monday at the Boise Town Square Mall here. The facts and information of which is still unfolding, but the first responders were tremendous. Another example of why they're so important, and so thank you to all our healthcare workers and first responders. Also, we couldn't put on this great event every year without our sponsors. We've got 4 presenting sponsors with whom we've got great long-term partnerships and relationships with at Colliers. So a special thank you to A10 Capital, Washington Trust Bank, Givens Pursley, and Land Pro Data. We appreciate their efforts year after year. Also, we have a number of co-sponsors this year helping us. Crexi, Infinity Signs, Cutting Edge Landscape, ServPro of Boise, Centermark Roofing, and Syringa Networks. Thank you to all of them for giving us this opportunity and bringing this great event to you. I'm now going to take a second and introduce Dr. Michael Wilkerson. Dr. Wilkerson is the Director and Partner of Analytics with Econ Northwest based in Portland, Oregon. Dr. Wilkerson brings 15 years of experience in the private sector as an economic consultant, focuses a lot on real estate development and its interaction with the local and regional economy. Being based in Portland, Dr. Wilkerson has a lot of great information, both on a local level here and a national level. He follows many of the economic trends, and I know with many of the things changing right now, a lot of uncertainty in the economy. Look forward to his comments, and so I'm going to turn it over in a second to Dr. Wilkerson. And before that, though, we have a quick word from one of our sponsors.
Hello, I'm David Bailey from Land Pro Data. I've been an engineer in the land development business for almost 30 years. Land development professionals need a more efficient and faster way to reliably get the critical information we need to identify, buy, develop, and sell land. I want to help land development professionals take this to this. That's why I started Land Pro Data, to alleviate the hassles our industry faces in retrieving land information and instead focusing on winning the work. Land Pro Data is here to help you do your job, save you time, and produce reliable information quickly. Many of our customers tell us they couldn't do their job without using Land Pro Data. If you want to be successful in this competitive field, I wouldn't suggest going up against our customers without being a customer yourself. Are you ready to retrieve the land data you need, anywhere, anytime?
Hello, everyone. My name is Mike Wilkerson. I am the Director of Analytics at Echo Northwest, a regional economics consulting firm based in Portland with offices in Boise, Seattle, and Portland. And excited about the opportunity to talk to you a little bit about some of the perspectives that I see nationally and regionally in terms of the commercial real estate market in the Treasure Valley. I want to thank Colliers for the opportunity to participate today and have this conversation with you. Certainly prefer to be in person for these types of things, but if anything, I think the last year and a half has taught us to be resilient and kind of adapt to new normals. So typically when talking about commercial real estate markets, I think it's helpful to have a baseline understanding of what's happening nationally. And certainly today, There's a lot of uncertainty going on related to the pandemic in terms of national policies, et cetera, that are impacting real estate markets and individuals differently. As it relates to specifically to Treasure Valley, it's on a growth trajectory that makes the market fundamentals here much different than what you'd see nationally. So I think what I'm largely focused on today is trying to unpack some of those differences and provide some perspective on things that might be relevant for you as you approach your particular market types in the region. So I'm going to share screen now and drop off camera so that we can see the screen a little bit better. And we'll step through this. So, a year and a half ago, we were in the midst of the longest economic expansion in US history through January of 2020. And then out of nowhere, seemingly, the pandemic hit us, and we had the largest job loss in a given month, followed by the quickest recovery. And the recession itself technically only lasted 2 months. Certainly individuals are feeling the ramifications of that through today, but from a technical sense, the recession only lasted 2 months, which was, again, the shortest in US history. Boise specifically and statewide in Idaho were less impacted than what we saw nationally in terms of the initial job losses at 11% versus 15% nationally. In terms of the recovery, which in Boise, as of the new year, had recovered most, if not all, of the jobs that had been lost relative to the US. That's still down 3.4%. And again, this is just in terms of total numbers of jobs, not necessarily looking at unemployment rates, which is a little bit different. In 2020, the word of the year was unprecedented. I think now what we're moving into is more of an understanding of what's likely to be the new normal. Changes that were implemented in terms of COVID, I think, is a big question. And so Urban Land Institute does a study every year where they survey thousands of real estate professionals around the country and ask a variety of questions. And this one specifically was getting at, would we revert back to pre-pandemic activities, broadly speaking? And the surveyed respondents thought that only about a quarter of them said yes, where most were disagreeing. And I think one of the areas that we're understanding is having the largest areas of uncertainties around the share of people who are working from home, which was pre-pandemic only about 5% of people. And we're seeing estimates now that might be 20% of all employees. And again, that's not off 20% of office, that's of all. The percentage would be quite a bit higher in specific office, including what hybrid work environments might look like. In terms of the broad market sentiment, NAIOP does a survey of the sentiment index and really kind of looks at this inflection point of 50 being where you would expect unfavorable conditions in the next year, whereas greater than 50 is favorable conditions. And as of the spring of this year, you can see that we went back to positive territory again and are in line with the several years leading up to the pandemic, which is, as we all know, a strong market for commercial real estate. The same survey of ULI tries to unpack in a few key categories, what are these largest threats or important issues that people see in the industry? And squarely today, those largest threats are related to construction, particularly the material costs, the labor availability, as well as some other factors around job and income growth, capital availability. These are all kinds of other concerns, but predominantly we're seeing this unfold in the commercial real estate space. What they're also surveying individual respondents on are kind of thoughts around topics like inflation and investor return expectations over the 2022 and going out further into a 5-year time horizon. What you can see on this chart is those orange bars are where we think that the respondents of the survey think, for example, inflation is going to go up, whereas the green is roughly remaining the same and blue is decreasing. So you can see from an inflationary standpoint, the expectation from these respondents is that we think inflation could be sustained at a high level for even up to 5 years, much more so than the number of people who think inflation is going to drop. Relatedly, you would expect then that the investor return expectations are also going to increase, is what you're expecting to see across from these survey respondents. The two other related components that I think are likely to have the largest impacts on particularly feasibility of new development, but also just asset valuations and transactions are commercial mortgage rates and cap rates. And commercial mortgage rates, if you look at it, 2022 roughly the same number of people think you're going to have rates the same as they are today versus up, but very few people think we're in a declining mortgage rate environment. But if you look out over the next 5 years, almost everyone thinks that rates are going up. And relatedly, you think you start to look at cap rates. And I think here is where is probably the most important factor in terms of determining feasibility in markets broadly. And certainly we've had sustained cap rate compression for the better part of 2 decades in most markets. And so this would be a real inflection point if we now move to a rising cap rate environment. I think you look at it 2022, most people think cap rates are the same. A few people think they might increase, decrease. But you look at over the next 5 years, more people are expecting cap rates to increase than stay the same, and very few are expecting continued compression. So this will have impacts broadly across all asset classes. So that's kind of a national overview in terms of what we're seeing in terms of surveys and some specific trends happening nationally. I think now we want to unpack a little bit about what's happening in the Treasure Valley and how that growth is contextualized by the rest of the Pacific Northwest. ULI does a survey every year where they're asking for the overall development prospects of a market. And they survey, again, thousands of people across the country, and they kind of rank individual market areas. If you go back a few years ago to 2017, Portland and Seattle were really at the peak of their ascendancy in terms of where people were thinking were large opportunities for real estate. If you go back to, again, 2017, Boise was in around 46, which is about where it had been for many years prior to that. What you see start happening in the latter years of, let's say, starting in 2019 is, Seattle and Portland, in terms of their overall attractiveness nationally, started to decrease a little bit from where that peak was in 2017, while Boise was continuing to hold in that kind of low 40s and 50 range. What happened starting in 2020 was really a couple of things. One, Seattle moved back up into the top 10 while Portland stayed in and around 20th. But the biggest thing is Boise started to slowly move up. And so where Boise had been historically in the low 40s and 50s, now moved up to 43rd. And then 2021's estimate happened, which was again at the end of 2020, which is really saying this is well into pandemic times now. We saw a big change. Seattle dropped precipitously, Portland dropped even more, and Boise had this huge increase in terms of its profile nationally into the top 20. And that's a big change from where Boise had ever been previously. And in 2022, which is the report was just recently released, Seattle again back into the top 10 markets, Portland still suffering some of the stigmas associated with the pandemic and many of the factors in that specific market. But Boise has really solidified itself now in the last couple of years as a top 20 market, which again is a big change. And we'll start to talk about some of the reasons as to why and what that means for the commercial real estate industry going forward. I think the largest reason, and this is certainly no surprise to anyone watching this today, is the population growth rate in Boise has been very large. In fact, it's the 5th largest MSA of the top 100 in terms of its growth rates over the last decade. And so you can look here, nationally, population grew about 7.4%, again, during that decade, 2010 to 2020, whereas Portland and Seattle were in the 13 to 16% range. Boise, quite a bit higher at 24%, only trailing 4 markets, Raleigh, Orlando, Provo, and Austin. In terms of some contextualization, Boise is now the 77th largest MSA. So other than Provo here, which is really part of the larger Salt Lake City market, different circumstance than Boise finds itself, is quite a bit smaller than all these other markets, with, say, Raleigh as the next largest, closest to Boise, but again, at nearly triple the size of what we're seeing in Boise. If you looked at the recent report from ULI, what you'd see is that these large growth markets are all also in the top 20 of market prospects. Austin, Raleigh have consistently been in the top 5. Orlando has been in the top even 5, but really dropped a little bit in 2022. And Provo, as part of that larger Salt Lake market, is there. And so for Boise, this is pretty atypical in the size of the market relative to other markets in the top 20. It's quite a bit smaller. The size of the growth, I think here again, look at it on an annual basis, is about 5 times larger in the Treasure Valley than what you've been seeing over the last several years nationally, which is to say nationally, population is growing about 0.5 or 0.5% a year. in Ada County and County both over 2.5% growth a year. You can see, rest of Idaho growing at less, about 1% versus what you see here in the Treasure Valley. In terms of where that growth has happened, here we're looking at census tracts in terms of numbers of population growing between 2010 and 2020. And what you'll see is the largest growth areas were outside of the city of Boise. Again, no surprise to people, Meridian, Nampa, Caldwell, Eagle, for example, is where most of the growth has happened, which is to say outside of the main central city. And that growth trajectory is quite a bit different than what you see in Oregon and Washington, where growth management acts and urban growth boundaries restrict where growth can happen. Idaho has much more opportunity for growing out rather than densifying. And so if we kind of look at this map, there's a lot going on in terms of dots, lines, et cetera. But let me try to walk you through what we're looking at here. And so effectively, we're measuring growth from 1990 to 2020, so the last 30 years. And we're looking at two things: the land area that was developed and housing prices. And here we're controlling for inflation. So if you look at land area alone, that's going from right to left, or the horizontal axis. You can see since 1990, Boise has roughly tripled in size in terms of the land where you see residential developed. That's on minimum density thresholds. When you look at the vertical axis, or going up to down, you can see again prices have more than doubled. This is controlling for inflation. Prices, not controlling for inflation, are much higher than that. And you can start to see these trends and groupings emerge. The blue is kind of the trajectory over time of Boise, but really what's mirrored growth in Austin as its closest kind of peer market in terms of similarly growing in terms of the size geographically of the market as well as price. When you look at Portland, Seattle, and even really Salt Lake and Denver, prices all grew at a similar rate, but the land area growth was much smaller. For example, Denver and Salt Lake roughly doubled in size, whereas Portland and Seattle, again, because of that growth management, only grew by about 50% over that 30-year period. So what's driving specifically growth in the Treasure Valley? I think the answer is it's different than what you saw happen previously and currently, let's say, in neighbors in the Northwest. And so Portland, in about 2014, you started to see news articles in the New York Times and other places talking about, will Portland be a retirement community for the young, essentially the Portlandia hypothesis. Seattle, the headlines are all about, Amazon and other tech companies growing in the urban core, high density, and what cost of that growth is. You start to see headlines around, Idaho and specifically Treasure Valley. It's really about this massive growth that we've seen. So you see headlines like even COVID can't stop Idaho's economic boom. Again, we saw that population growth and job growth is continuing through the pandemic. But what you're starting to see more of is articles around, yes, the economy is booming, but at what cost? And so this particular headline from a local news station was saying, low wages weren't an issue due to the low cost of living for a while, but the population boom has jacked up housing prices and eroded affordability. And so this is, I think, although the headlines are different than what you saw in the Northwest, the themes in terms of where you're heading are similar to what you saw happen, let's say 5 years ago plus in the neighboring markets in the Northwest. Really what's fueling this growth is millennials entering two key phases of their demographic transition. One is forming households, which is to say moving out of parents' homes typically. And that typically is around 26 years old. And you can see that's the tail end of the millennial generation. And then you have that median age of the first-time home buyers, more like 34. And that's the beginning of the millennial generation with larger age cohorts coming in the next several years. So I think you can start to look at millennials coming of age in high cost, predominantly West Coast markets, and looking to understand, where do they want to live, balancing quality life, affordability, job prospects, et cetera. You've seen quite a bit of migration happening for a variety of those reasons, which largely benefit Idaho and specifically the Treasure Valley. I think surprising to no one is what people are looking for when they're moving is larger spaces, both in the structure and the land, as well as lower costs. And Zillow has done some surveying of that to kind of show what that generally looks like on average. And again, this is nationally, not specific moves to Idaho, but nationally, people are generally spending about $27,000 less when they move to a new location than they did in their previous location. I think this is probably one of the most telling statistics in terms of where growth is coming from and why Boise is so different than what you see in, say, Portland and Seattle, which is to say, you look on Redfin and the share of searches coming from outside of Boise for people looking at homes in Boise is 73%. And where they're coming from, again, I think aren't a surprise. It's the large California markets, LA and the Bay Area, but also Seattle. I think what's maybe a little bit surprising is the ascendancy of DC. So a lot of people are looking to move out of DC, again, another high cost area, to where now you're seeing as many people searching, not moving, but again, searching according to Redfin for homes in Boise as they are in Portland. When you look at Portland, we'll look at Seattle next, very different story, which is, the vast majority, 80+% of people in Portland are where people are looking for homes in Portland. So you don't have nearly the number of people from out of market looking to move into the market. But again, the places that people are looking in Portland from out of market are Bay Area and Seattle and LA. Eugene and Boise is not in the top 10, and certainly less than 2% of those searches. So again, not a strong flow of people into Boise from Portland, but the other way around. And Seattle is very similar, with even fewer people out of region looking inside Seattle than they are in Portland. Bay Area being the largest, Spokane, second largest, Bellingham. So you have a lot of interstate move going on. And then Portland, again, Boise, not a lot of people moving from Boise to Seattle in terms of, at least from the searches in Redfin. So I think the big story right now is appreciation and how long can it last, and is this sustainable? And this is not a talk specifically about single family housing market and are we forming another housing bubble, et cetera. But if you look out at Zillow, they're estimating that we basically now are at peak appreciation, which is off the charts in Boise, as you all know, and looking at coming back down to, again, still very elevated levels in Boise, but maybe back down to around 20% in terms of the Zillow value matrix into 2023. Whereas Portland, Seattle, and the US are going to be at a lower rate, according to what Zillow is forecasting at over the next, say, 18 months. I think what's surprising about that forecast is, if you look and play forward where values already at today in Boise and continue that growth rate difference, that the median home in Boise could actually surpass Portland sometime between now and 23. And that's a big reversal from where we were for a very long time, potentially forever. And, looking back at 2017, 2018, where that gap in prices was nearing $200,000 in terms of median, which is about, again, double the price difference to make up that gap. Really starting in 2018 is a big change, and certainly no surprise to anyone living in and around Boise. But in terms of the regional attractiveness from an affordability play, is going to have some pretty stark impacts in terms of what you're seeing in terms of the general the value proposition of Boise from an affordability standpoint. You can look at a million articles. I'm sure you've seen them all. The top 25 hottest housing markets. This one's by the business journals, using, again, Zillow data, and ranked Boise as number one. They're looking at, over a 5-year period, what that looks like in terms of total change, what the 6-month is, a variety of things. But again, median home values are now, approaching 500,000 in the market. I think the big difference is when you're looking at prices, but you're also looking at incomes. And incomes here, what we're looking at is the full distribution of incomes relative to the US. So think of the red line as the US average income, and the right-hand side of the chart is your highest income earners. The left-hand side of your chart are your lowest income earners. So as you move from left to right, incomes are going up. And at the median, the middle household in Idaho is earning about 85 cents on the dollar to what the US is. The green line's looking at Oregon. Oregon crosses at about the middle. So, the median household in Oregon is earning about the US average, whereas in Washington state, it's quite a bit higher. And so when you start to think about incomes being across the board lower in Idaho than the US, certainly lower than Oregon and Washington, but home prices coming up, that starts to put some tension in terms of what that affordability looks like. And so there are lots of measures of affordability. You can look at price to income ratio, cost burdening, et cetera. But I think if you're trying to measure the long run affordability of a market, it's really about this balance between the number of housing units and the number of households. And nationally, that ratio is about 1.14, which is to say, for every 100 households, there's 114 houses available. And what that allows for is two things. One, a vacancy rate, and two, there's second homes and vacation rental homes that are also part of the market. And so you want to allow for both of those things, which is to say you need more than one home per household because of those two things, vacancy and second and vacation homes. So anchoring our expectation on target in terms of what that national ratio is, we can look at Ada County and Canyon County and see they're far below 1.05 and 1.03. Very, very constrained in terms of what that means for vacancy. And so a terminology that we typically use is underproduction. What underproduction says is, how many more units do you need to build to target that national ratio? In the case of the Treasure Valley, we're about 50,000 units short today of where you'd want to be using that national production ratio. For some contextualization, if we look at Seattle and Portland, you can see that these ratios are lower in the Treasure Valley than they are in even Seattle and Portland. So in terms of the long run affordability prospects, Treasure Valley today is actually on par or worse than we've seen from a housing balance or housing underproduction standpoint. So what does that mean for commercial real estate in the Valley specifically, and establishing a new normal? I think we have a couple of factors. That the largest uncertainties that we talked about are in terms of office and what a return to work looks like. Using that ULI survey, the largest category is, what does a hybrid work model look like, and what does that mean for office space needs going forward? I think what you see is two camps forming. Certain people are believing, yes, growth is going to happen. People are going to return to the office in earnest, in a hybrid or in a full-time environment. But those are only about 15% of people thinking, looking out 3 years, you're going to need more office space. The other 85% think you're going to actually need less office space than you do today. And I think, nationally, that may be true. I think Boise here is different than other markets for a couple of reasons. One, job growth has continued to happen in Boise, and office vacancy has remained generally low and at where it was pre-pandemic, versus nationally, it's up quite a bit. And you look at, for example, in Portland, vacancy rates are more than double what they were pre-pandemic. And if you think about just typical absorption relative to normal vacancy rates, we have 3 to 5 years of excess supply. And so you start looking at, regardless of return to work, hybrid, et cetera, just that increase in vacancy alone is why you see a lot of this happening, which again isn't that relevant in Boise. And I know there are panels talking more about specifically office and multifamily and others later, so won't get into too many of those details. But I think in terms of big takeaways, the ULI report is highlighting, I think, what has been years in the making, which is the growing profile of the region. And you're going to start to see more national developers and institutional capital flowing into the region, which is really what you saw happen in Portland and Seattle as they ascended in those rankings. Housing affordability challenges now are very present, similar to what you're seeing in Portland and Seattle. And so from a regional contextualization now, that's evening the playing field a little bit from what maybe traditionally was an advantage in the Treasure Valley. You're still seeing largely migrants from California and Seattle, where the relative affordability here in Treasure Valley is better, particularly when people are bringing equity to bear, so that even lower local wages can make up for that difference. Even if prices were similar, that large equity can really help to make it much more affordable. I think one thing that the pandemic is teaching us is, remote work is increasing, and that can be really instrumental in terms of allowing for opportunities for closing of that local wage gap. As we saw, Idaho's wages across the board are lower than you see in neighboring states in the region. I think a last point is, rents are now growing across the board, also straining the affordability, but also allowing for higher density multifamily construction. And so you're starting to see many more podiums being built in the downtown core than you've seen, 5 years ago. And really none of that was happening. So that's all new. And again, with institutional capital, the scale of those projects is going to start to attract, is really, I think, going to bode well for the near run future in Boise. The challenge is, at higher construction costs, can you deliver those at affordable rents? And I think that's the main point that we see in terms of any headwinds is this lack of housing affordability constraining long-run growth. And we're starting to see growth slow down in Seattle and Portland, and in no small measure because of housing affordability. So appreciate your time today. There's my contact information. Happy to field any questions if anyone has it. And yeah, look forward to seeing everyone in the future here in person one day soon. Thanks for your time.
A10 Capital, a nationwide direct commercial real estate lender headquartered in Boise. A10 makes loans from $5 million to $50 million on core commercial real estate assets. No depository relationship is required. All loans are non-recourse with permanent loan rates that are competitive with life companies and state pension plans. To learn more, head to a10capital.com. That's A10capital.com. Information, a lot of data there. For our viewers, there was a lot to digest, and I'm sure a lot of you will want to be able to reflect back on what he said, and we will have a recording of this entire event and have the information available, the presentation that Dr. Wilkerson had. It's really interesting to watch. For those of us living in the Treasure Valley, it's no secret that the growth has been phenomenal. Looking at the comparison, number 47 as far as commercial real estate opportunities in 2017, now in the top 20. Boise has certainly made its mark on the map, and we have been very fortunate here as we saw the unemployment figures, how we did not get hit as hard during the pandemic, and we certainly have regained the employment back to pre-pandemic levels. However, it's created a lot of pressures. The housing prices continuing to rise, wages not keeping up. That's going to create an interesting challenge for the area in the years to come. And then, some things that we'll touch again on with our panel of experts here in just a little bit. I thought it was interesting seeing how pre-pandemic, about 5% of the workforce worked from home. Now it's looking like about 20%. So what does that mean? And stay tuned. We'll have more conversation on that. Next in our presenters is Carolyn Holly. Carolyn is the Vice President of Development with Idaho Business for Education. Many of you may recognize and know Carolyn from her 33-year career at KTVB, Idaho's #1 TV station. And Carolyn also, we're blessed to have a partnership with Carolyn and work closely with her. She's very involved in the community, a number of different boards and groups, ensuring that the Treasure Valley community is as strong as it is. Carolyn's going to speak to you a bit about the labor force here in Idaho, some of the issues that Idaho's facing based on labor shortage, and also educational issues or issues with the education opportunities here in Idaho and how that impacts us going forward. I look forward to hearing from Carolyn. Before I turn the microphone over to Carolyn, we're going to have a quick note from our good friends at Washington Trust Bank.
At Washington Trust Bank, can't is a 4-letter word.
I think we should hire more people.
Doc, I'm late for a meeting.
I'm thinking of starting my own practice.
Do it. Too much capital.
We need a warehouse.
I can't imagine how we do that.
We should knock that wall down and expand.
Do it. There's always another wall beyond the wall.
We believe you can do whatever you set your mind to, and we'll help you get there. Washington Trust Bank, privately owned, locally invested.
Well, welcome everyone, and I love that I get the chance to come to you from the KTVB studios. We have all seen the signs, the help wanted signs, or maybe you've seen the 1,000 signing bonus start today. They're all over our city, our state, they're all over our country. Maybe you've noticed that your favorite restaurant doesn't stay open as late anymore, or that it's closed altogether. Or I've found I have to reserve a spot at the gym. National parks are so understaffed that you need a reservation just to go hiking. You cannot escape the labor crisis that we are currently experiencing. Or what about waiting for a shipment? Our supply chain is broken and it is negatively impacting us at the local level. So with that in mind, as they say, good luck getting your Christmas presents delivered on time this year. It's easy to put all the blame for this on COVID. But I think that the pandemic put a magnifying glass on problems that were lurking below still waters. What I'm curious about is this. I imagine the labor shortage has affected your day-to-day life. How many of you find yourself putting in more hours because you're understaffed? How many of you are late on orders because supplies aren't arriving on time? And how many of you are losing sleep over all of this? It is truly affecting our businesses from the top on down. No one is immune. It's a domino effect of losing employees and losing trust. I'm going to give you an example. A young entrepreneur in our city owns a booming company and decided to contract out some of her work. She was already invoiced, so she checked up on it, and the work hadn't been done. This is becoming more and more common as people view their jobs as easily replaceable. I know someone else who's the owner of a company and having to take the time to go to job sites just to check the work of his own employees. He finds out contractors are billing him without having done the work at all. And you know, hospitality is really hurting because people are choosing to leave the industry. Many are finding remote jobs, working from home is so common now. So if it's not just COVID to blame, what else is at play here? Well, let me give you some things to think about. Women are really affecting labor in our country right now. Our fertility rate is decreasing. Couples are not reproducing at a rate to keep up with the workforce demand. Women are also pursuing higher education in larger numbers than ever before. And of course, the pandemic took its own toll, and many women left the workforce to stay home with their children who couldn't go to school. And even now, they're facing childcare shortages that are preventing a return to the workforce. Immigration policies have tightened up. Baby boomers are leaving the workforce earlier than they anticipated that they would. These are just a few of the contributing factors to this growing problem in our country. So the question is, where do we go from here? It is so easy to focus on the problem and not work to find the solutions. But I believe education is the answer, and it's time to pay attention to it. We need to invest in our children's education. So in the future, we've got a workforce we can depend on. That's why I'm so proud to be a part of Idaho Business for Education, or IBE, and to be part of the work we're doing to strengthen and transform education in order to create a skilled-up workforce. But we have a long way to go. Our go-on rate is currently 38.2%. We have room for improvement, to say the least. And we need to be open to what that go-on can look like. For example, our federally funded youth apprenticeship program, which we launched during COVID, has the potential to get young people into jobs they're interested in starting in high school. If you haven't heard about this yet, pay attention and make sure that your HR departments know about it as well, because work-based learning and youth apprenticeships are a game changer for employers and for students. Within Reach is a program where IBE has partnered up with the San Francisco Federal Reserve. We're going to be working with major employers to talk to their employees about how they can encourage their own kids to go on, do something after high school graduation. We need to start having that conversation about what go on means, whether it's a certificate, an apprenticeship, a community college, or a 4-year degree. Keep on learning after you get that high school diploma in order to continuously improve your quality of life. We want Idaho students to keep on learning so that they're prepared for the jobs that you as employers are offering up today and what you know is coming in the future. Bottom line, we don't always prioritize education in our state. It's time we do so. It's time we help prepare young people for the jobs that will allow them to enjoy the richness of our state. Your companies depend on it. Your families are depending on you. So here's my hope, that we look back in 20 years from now and we see these difficult times as a catalyst for change that help propel Idaho's workforce to where it needs to be. We can't do this without our children having a firm education, a firm foundation in education. Don't let COVID hold us back. Take the obstacles in front of us right now and turn them into opportunities for the young people of this great state. Thank you.
Welcome back, and I want to thank Carolyn Holly for some terrific information. I think obviously we're all feeling the effects of the labor shortage across the country. We've all seen businesses that have shortened hours, they're short-staffed, and Carolyn really points out one of the most important things is not only do we need numbers in the workforce, but we need an educated workforce, a qualified workforce, and the way to do that is to keep our emphasis on education, support our kids, and make sure we have the strongest workforce going forward. So thanks again, Carolyn. And for you, those of you that aren't familiar with Idaho Business for Education, terrific group. And I ask for business leaders in our community, please get behind them and support their efforts. We're now going to transition, and in a moment I'll be introducing our panel of experts, of local Colliers individuals. First, I do want to make an announcement that we're very excited about. We will be launching, and I believe it may have just gone live, our Commercial Real Estate Outlook podcast. It's a new podcast that we're putting together, interviewing individuals from Colliers, from the business community, the real estate community, both locally, regionally, and nationally. I think it's going to be an exciting opportunity for you to continue to get insights from our group and keep up to date on the commercial real estate trends from Colliers, who's clearly the leader in commercial real estate in the state of Idaho. So we look forward to it. We will have information where you can access the podcast, both on Google Podcasts and Spotify. So please look for that. Again, the Commercial Real Estate Outlook podcast presented to you by Colliers. Now I'd like to introduce our panel of experts. We're going to take a little time here and got some questions from them. A lot of these questions have been submitted by you, the audience, and the attendees of this conference. So we're trying to bring you information that answers not only your questions, but things that these folks know are really important to the market today. First, starting in order from the end of the group here is Mike Pena. Mike is a partner owner here at Colliers in Idaho. He's a generalist in brokerage, working out of our Canyon County office in Nampa, Idaho. Welcome, Mike.
Thanks, Jim.
Next is Michael McKnight. Michael is an industrial associate, obviously in one of the fastest and hottest areas of the market, the industrial sector. Glad to have you with us, Mike.
Jim, thanks.
Seated next to Mike is Amanda Snowy Holiday, our Director of Property Management. Amanda is responsible for managing the largest portfolio of third-party managed properties in the state of Idaho, both overseeing the real estate managers and our maintenance technicians that take care of all these properties. Glad to have you.
It's a pleasure, thank you.
Next to Amanda is Scott Feiner. Scott is an office associate, also a partner owner in the company, and Scott is a longtime expert in the office market and also has a lot of focus in medical office. So we look forward to hearing Scott's input.
Thanks, Jim.
And then next is Kelly Schnebley. Kelly is in our retail group. She's a retail associate. Previously, Kelly had served many years in property management, both in Seattle, Washington, and at Colliers here in Idaho. Welcome, Kelly.
Thanks.
Next to Kelly is Clay Anderson. Clay is an investment associate, also a partner owner in the company. Clay has been with Colliers a number of years, one of the leading producers with our company, and today most of his focus is in the multifamily market. He leads one of the strongest multifamily teams in both the region and the nation. Glad to have you with us, Clay.
Thank you.
And last but not least, we have John Starr. John is also a partner owner, and he is a land associate. John is lucky to be involved in the great Idaho land rush of 2021, and we'll hear more about that as we go forward.
Thanks,
Glad
John.
to have you, John. So we're going to have some questions for our group here, and also if you are interested in asking questions, specific questions to them, I do have a little teleprompter here next to me, a little monitor that your questions will come up so I can share them with one or more of the panelists. If you want to ask a question, you can text it. Text it directly to 208-412-7288. Again, it's 208-412-7288. So moving forward, I'm going to start off, with what I call the 800-pound gorilla. We saw Dr. Wilkerson talk about a 5% work from home rate prior to the pandemic. Now it's up to 20%, maybe more. I think still waiting to see where everything goes. But Scott Feiner, want to ask you, what are you seeing in the office market? Is the office market dead?
Well,
what's happening?
Yeah, I guess I'm still here this year, which is good. We'll see what happens next year. I might become a residential agent. No, seriously though, the pandemic did have a big impact on my business and leasing velocity. Pre-pandemic, I was doing personally between 40 and 50 leases a year. Post-pandemic, current pandemic, however you want to think about that, I'm doing 20 leases a year. And one of the metrics that we look at in what is a healthy market, if you looked at the vacancy rate in office, you would say, well, this is a very healthy market in that we are below 10%. Actually, Ada County, we're about 5.6%. And in Canyon County, we are, I believe, 2.1%. So you look at that and you say, wow, this is a really healthy market. But you kind of have to dig a little deeper, and I've yet to hear economists or get any data on this, but what I'm interested in and looking at is not just the vacancy, but also the utilization. For example, I'll be driving around Meridian doing a tour, and I'll look at two call centers there. One's T-Mobile, and the other is Citigroup, and those two call centers make up about 250,000 square feet in the Meridian market, so roughly about 4% of inventory in that market, and there's no cars in the parking lot. So, while we have, actually Meridian has about a 12% vacancy. So what is the true vacancy? What's going on with office space not being utilized? So I want to look at more at that, and so that's been really interesting to me.
It's interesting, Scott. You talk about that with the occupancy versus utilization. Does that, it seems that lends itself to a more robust sublease market, perhaps. Are you seeing changes in the amount of sublease opportunities out there?
Not as much as what I've been hearing from my colleagues on the coast and in Salt Lake, where those markets, I've heard are, 25, 30% of what's listed on a market is for sublease. We're not quite seeing that yet, but we are seeing some large blocks of space come onto the market. We're seeing a lot of companies, and this gets back to the velocity, figuring out how they can occupy, work with their current landlord to downsize, make their space more efficient, versus, hey, let's just tear up our lease and try to go home. So we're seeing a lot of people just, trying to make it work, less so by just putting their space up for sublease, at least for now.
Yeah, no, that makes a lot of sense, and I think as far as the pandemic, you saw from Dr. Wilkerson a lot of the stats on what's happening in this area. Things are still going very strong. I think we still have a bit of a wait and see on how the office market really will be impacted long term. We'll get more from you in a minute, Scott. I want to turn from Scott, who was worried about whether he's going to be a broker next year, to the industrial side. Michael McKnight. Now you're in one of the strongest sectors of the industry, both locally, regionally, and nationally. What can you tell us, Michael, about what's going on in the Treasure Valley and around Idaho with vacancy rates and future developments? What's happening in the industrial sector?
Well, Jim, that is a great question because the answer is finally different. Looking ahead to this next year, we are going to see a lot more product come online, and not just a couple 100,000 square foot concrete tilt buildings. We're going to see several new Class A industrial development projects either be completed or break ground this next coming year. And it's just great to see because our market has been starved for true big box product for years now. And having new players, existing players, very capable, sophisticated industrial developers providing solutions to these new users, either expanding or coming into our market, is really great to see. And we're tracking, our industrial team, we spend a lot of time tracking new projects, and we're looking at millions of square feet coming online this next year. And you look at that and go, well, what's that going to do to the vacancy rate? it's much like multifamily, I would say, and maybe Clay can jump in and correct me if I'm wrong, but we're just constantly playing catch up, and we just really can't build it fast enough right now. And I see a lot of this new product that is being delivered is going to be absorbed quickly and most likely pre-leased, which will continue to keep the low vacancy rate.
So Michael, with all that new square footage, I mean, million plus, 2 million square feet coming online, for a long time this market was dominated with one or two local players. I'm assuming there's got to be a lot of regional and national development interest in the area?
Yeah, no, you're exactly right. I think, looking back a couple years ago, we were on the radar for a lot of these developers, California, Washington, Oregon, and they'd come in and we'd talk to the market, and it almost felt like they were just kind of sticking their toes in the water. That has changed within the last year or so. I mean, we have new players, very sophisticated players. Just one to mention is LDK Ventures. They're here in our market now, and they're doing really great things.
Yeah, they've had some large transactions.
That's right.
And filling up a lot of space. I know also, obviously, that big facility we all see off of I-84 in Nampa, the Amazon distribution center, was a big impetus to further development in the area. And as I mentioned that, I want to shift to Mike Pena for a moment. Mike, we talk about new office development out in Meridian and 10 Mile, and we talk about industrial development. You've spent several years heading up our Nampa office, and for a long time it seemed like there was a real distinction between Canyon County and Ada County. What's the perspective, these days?
Yeah, that's some good insight. And we opened up our office in Canyon County in 2007, and there definitely was that imaginary line between Canyon County and Ada County in perception of where tenants wanted to be. That's kind of been erased in the last couple of years. Canyon County has been fully integrated into part of the Treasure Valley. I think everybody's seen that the population growth has continued to move west. When you look at where there's large chunks of undeveloped land with good ingress and egress, I mean, just looking at Nampa, there's 5 interstate ingress and egress points from I-84, and it's just ripe for development. Another thing that we've talked about earlier was the population growth. Canyon County now has over 240,000 people in the county, so that's a large employment base. A lot of that ties into industrial growth too. I think if you go back to some of the Outlook tapes several years ago, one of the predictions I made is that Canyon County is going to lead the valley in industrial growth in the future. And Michael hit upon that. The vast majority of new construction projects have been done in Canyon County recently. In fact, right now, I think we've got just under construction, not planned, we've got about 1 million square feet in Canyon County versus 500,000 feet in Ada County.
And that's just an industrial.
That's just an industrial.
Right.
And I think Michael's tracked a little bit of, what are we at, around 3 million?
Yeah, I think we're just at about 3 million square feet of new product either coming online or going to be finished.
Going to be finished in the industrial. And so what's that's doing is it's creating jobs, and it's driving housing needs out there, which creates demand for office, retail, multifamily. So we're very confident to see this growth continue in Canyon County. The other thing that's been helpful is some of the government policies in the pandemic have been fairly friendly. One of the odd things is our hotel vacancies have been very high. And right now there's a lot of demand. We're working with a few hoteliers to build some new hotels around the Nampa area.
Well, a lot of good growth, and it really has, we're seeing the lines blended between, the Treasure Valley is truly a unified market between both Canyon and Ada County and what's happening. And I agree, Mike, it's been nice to see you over in the Boise office a little more occasionally, because I guess that barrier's gone on I-84 between the two counties.
That's right.
Staying on a hot market, we're talking about industrial. There's, as I mentioned in the intros here, the land rush of 2021. I'm actually a little surprised to see John Starr sitting here, that he has a half an hour to spend with us with all the activity that's going on. John, what can you tell us? What's going on right now with the development opportunities and land sales in the area? What are you seeing?
Well, Jim, we see just the demand for additional land for all kinds of uses, whether it's industrial or multifamily, single family, is high, where the competition is fierce. And there's probably traded hands in the valley, somewhere in the neighborhood of $200 million worth of just residential land in the last 12 months. And that doesn't count the $200 million that traded hands last year. When you talk about, is there a bubble coming? What's the adjustments on the market and all that sort of thing? We're prepared for more growth from a land standpoint, from a development standpoint. But the builders and developers I talk to on a regular basis, all of them will tell you that, we just lack the labor to execute at the levels, that Dr. Wilkerson was talking about. We have a shortage, and we continue to have a shortage just because we just can't build enough. So the demand for land remains very strong, but it's tough to meet that demand with the resources we have.
What is your outlook for that? Do you think that labor shortage, the construction costs will hold back too much, or obviously as seen in the numbers, the folks are still coming here, so we need more housing.
Yep.
Commercial development follows housing development. What's your thoughts?
It's a tough deal, like Ms. Hawley was talking about. We have to get more labor, educated labor, even in the construction field, out there in the marketplace doing the work. Part of those people that are moving here for construction jobs because they're good paying and they're available. So it's just going to be a long slog. One thing that's for certain is that we're not going to see a lot more price increasing either on the land side or on the housing side, just because we've kind of reached some limits. People are tired of seeing those increases in housing costs, but we're just not producing enough product to get ahead of that demand to really put a cap on that. So while we've seen a slowdown or a flattening more recently in residential, I really think we're going to see some higher prices coming because the demand is there.
Speaking of demand, Clay Anderson, welcome, and multifamily. I think folks, I hear it every week. Can we afford to have another apartment complex built, another condominium complex? What are you seeing in the multifamily in our region? Obviously, we see a lot of activity. What's your view?
I think maybe to segue off what John was saying too, on the land side, you have demand from a home building standpoint. And then you have quite a few regional and national institutional groups looking to do the build for rent model. And so they'll take down a tract of 20 or 30 or 40 acres and plan to do a home subdivision that's all for rent. And so that's a subset of the market that is a really big trend nationwide that we're seeing a lot more of now here. There's a handful of institutional groups here now looking to continue to acquire ground to fill that gap. So it's kind of the housing prices going up, apartments are performing very well, but then this single family rental or build for rent model is going to come in really strong. We haven't seen it visibly that much. There's a few projects that have occurred. But then on the apartment side, and we go back to what Dr. Wilkerson was saying and talking about how our home affordability shifted so much and our wages didn't really climb as fast. But if you look at people look around the valley and say, man, there's a lot of apartments going up. It feels like we're overbuilding. If you go back a few years, and we track the data on this, because back then home affordability was so reasonable, you had a kind of a natural ceiling on apartment development because people were just buying homes. And so if you push your rent too hard, they'd go buy a home. Well, now that affordability in homes has shifted so hard up, the renter or tenant is going to be in there longer. And if you look at the data for Idaho, for Boise particularly, compared to other Intermountain West cities, our apartment stock per capita was almost half of what it is in other Intermountain West cities. And so you take Reno, Sacramento, Denver, Salt Lake, Spokane, you take all these markets and say, well, where are apartments relative to those markets? We were way undersupplied, understandably because our rents were lower and our housing was more affordable. But now that we've shifted on par with a lot of those markets, not perfectly on par, but closer, then you'd expect that ratio to shift. So we have a ton of runway in front of us for apartment development. And
so why does it feel like every time I drive down Myrtle or Front, it feels like a new building's coming out of the ground? Like,
yeah.
I mean, is it really? So it's not as bad as we think.
No,
it is?
now the downtown has a lot going on.
Okay.
If you look at the pockets, there's downtown, and then 10 Mile feels really heavy. But there's limited spots where development is occurring, and so if you take the whole valley and say, well, we're going to add, 1,800 units, well, half of them are at 10 Mile, and the other half are downtown, and so it feels really heavy. But we're going to be playing catch up for years.
But what's crazy with all that development too is the vacancy rate in Ada County is, for multifamily, is 1.16%, and in Canyon County it's 1.54%. So we have that feeling of all this building being done, but the absorption is really strong.
It's very strong. Yeah, you'll feel a little bit of a hiccup. Like we have a seasonal slowdown in leasing in the fall, and because there's so much product that hit, we've felt it a little bit, but it'll absorb back out through the spring, and I think we'll be back.
So I'm curious. You talk about the apartments being the affordable housing option, and one of the questions that we get a lot, and I see one of our viewers has asked, is what's being done to encourage more, not on single family, but within the apartment sector. And I guess I'd ask Mike or Clay or John, any of you on affordable housing. Are there initiatives? Are there things happening? Obviously, the developers are going to build and need to make a profit. They can't just build and give away apartments. What's happening in the affordable housing market?
Well, I'll start out by saying that, I'm impressed that the city of Boise has actually reached out to the business community to start seeking answers to that. And, the toolbox is a small toolbox, Jim. It consists of low-income housing tax credit, some new market tax credit, and that's about it. So the cities that want to address affordability are going to have to figure out how to enhance the toolbox themselves. One of the things we've seen here in the downtown core is the developers listening to the city talking about affordability and offering up affordable units from an organic standpoint, saying if you'll approve our project, we'll give you a certain number of affordable units. And that's encouraging. That's a direct participation by the development community in that problem. The city only had to mention the problem, and they jumped in. But the cities have a long road ahead of them, I think, in addressing it.
Well, it's always an important question, and as any city that grows, if you don't have the affordable housing to support that workforce, the younger workforce that's trying to get into their either their first apartment or first home, we need to have the affordable housing options. And
I think one of the other solutions, Jim, is we have a great company in Napa called Auduval, where they're doing some robotic manufacturing for housing units that are not necessarily in the Idaho market yet, but if you look at California and some of their higher labor markets, they're able to come in up to $100 a square foot lower to build apartment complexes. So I think as that technology gets more adopted and there's efficiencies of cost, that there's some options there on the way some of these new housing units will be built for affordable work housing.
So shifting gears for a second, Kelly, I'd like to ask you a little bit about on the retail sector, and it's kind of funny. Retail's been dead now for 20 years, I believe. Whether it was Amazon or now the pandemic, retail's gone, right?
Yep.
And I think clearly that's not the case. But one of the things that we all see on a daily basis, and Carolyn touched on it, is the labor shortage. What are you seeing from the standpoint of the impact on both landlords and tenants in the retail sector with the labor shortage?
Yeah, it's definitely putting a lot of pressure on those retail tenants, and that is where it's most apparent, this labor shortage. Like Carolyn mentioned, restaurants closing earlier, stores closing earlier, being closed on certain days, and it's sometimes changing the way tenants are thinking about either expanding or whether to even renew their lease. We haven't seen a significant number of retail closures related to the pandemic itself, but what has been challenging is finding labor finding labor that can live near your restaurant and be able to access work, that has actually caused some tenants, to decide not to renew their lease, to decide not to expand or put off expansion. So it has, wide-ranging effects.
Are you seeing a change or a shift in the terms of leases that folks are looking for right now? Are you seeing more shorter-term leases desired, or the ability to get out of a lease, at a certain point with the uncertainty from the pandemic?
Yeah, there's definitely some desire for more flexibility, but we're seeing a lot of the lease terms really being pushed by construction costs in new developments, where you need to have a 10-year term for the project to pencil. That's really what's pushing that more than what any tenant wants. They don't really have much of a choice.
Same on the office side. I mean, that's what we're seeing. A new project going in, it's got to be a 10-year lease minimum. But renewals or second generation landlords are actually, some of them would prefer a shorter term lease. And that works out well for the tenant and the landlord in case there is, hyperinflation on the landlord side, that they can renew them at a higher rate. And then it also, from a tenant flexibility standpoint, that's great. But again, with construction costs where they're at, if it's going to be a new build or a major TI, it's going to be a 10-year lease.
Well, Scott, you mentioned construction costs and landlords. What's happening as far as TIs due to the pandemic? How are landlords absorbing these costs? And obviously a lot of the costs get passed through to tenants. What are you seeing?
So it's certainly it's kind of a double-edged sword. The tenants are staying put, so the velocity of transactions. Tenant needs to grow, and they need to move out of their building. They're figuring out ways to stay in their building. So from a landlord perspective, it's like, great, my tenant's not gonna jump ship on me. And so you're seeing a lot of tenants kind of figure out how to reconfigure their space as it is and not move around. That's where you're kind of seeing that lack of velocity, where pre-pandemic I was doing 40 to 50 leases a year. Now a lot of the tenants are staying put and figuring out how to operate within their own space. One thing we're seeing landlords do for new leases to kind of control some costs is no longer cap operating expense increases. So I represent both landlords and tenants, and one thing in office, it's very common to have a what's called a base year lease, where your operating expenses get locked in. Well, when I'm representing a tenant, I'll say, hey, we want to cap our operating expenses at 5% year over year. Well, I'm urging a lot of landlords right now to say, because we don't know where costs are going, things like that, do not cap expenses, because that's a real going to be a real big issue, and has been a big issue this year, with especially a lot of tenants who 8 years ago locked in their controllable expenses going up. So
a lot of those tenants are getting a double whammy. I mean, just on the industrial side, several years ago, it was typical for the triple net portion of a monthly rent to be 10 to 12 cents a square foot for triple nets. Now it's 20 cents.
Yeah, not anymore. We're
20 to 25 cents.
And north of 20 is going to happen, and so the tenants are seeing a big hike in their base triple net rent, but the fees have doubled.
Yeah, fortunately in office, most people, for the landlords, I guess, and for the tenants, I guess, for the tenants, more so, is that they're full service leases, so they're not triple net leases, and I can see where that's a...
Yeah, but and the vast majority of those fees, though, are from property valuation. So, I mean, property values are going up, so the way what you're saying is that the landlord's eating that extra tax, basically, if they don't structure that right.
Amanda, I'm curious from the property management standpoint, what you're seeing, on these, whether it's triple net costs or just, operating costs. What are the trends you're seeing, and how does this market compare to other markets?
We are definitely seeing an increase and feeling the impact here in Idaho as well. Triple nets, annually now are going up to anywhere between 4 to 8%, which is, anybody that's native Idahoan, it's kind of a little bit of a culture shock to you, get your heart palpitating a little bit. But national average, we're way underneath. The reports that we've been getting were anywhere between $10 per square foot, clear up to $17 per square foot. So on the national side, we're incredibly safe, but people are definitely finding our beautiful little pocket and venturing over there and kind of driving up prices.
Well, we benefit. Idaho benefits
Of course.
a lot. One of the big factors is utility costs, and power in Idaho. It's one of the least expensive in the country. So obviously that keeps that down, where other places that cost may be driving up. So certainly there's an opportunity here for tenants, to find lower costs. Now this is not your base rent. This is the operating costs, the triple nets, above and beyond the base rent.
Our insurance is definitely lower. Our taxes are lower than other places as well. So it all kind of combines in it to keep our triple nets down lower.
Despite increased costs that you may be seeing on the maintenance side, whether it's landscaping or janitorial or where the inflation is driving things up.
Correct.
So Amanda, staying with you for a second, the property management, throughout the pandemic, you talk about an area of uncertainty and having to adapt and react, and landlords certainly had to adapt. We all were, I think, in a panic in March and April of 2020 that folks were just going to stop paying rent. We had a lot of government opportunities, PPP funds and different things. What have you seen through the pandemic and now? Are tenants, even the ones that Scott talks about that may not be utilizing the space, they still continue to pay rent and stay current?
Yes, they are continuing to stay. We've had, minor losses and stuff. In fact, we had prepared at the beginning, March, April and stuff, we were preparing packets to owners and stuff to delay payments or push them back or find some way to deal with all of that. And we probably prepared about 47% packages ready to go. But in the long run, we only ended up, because of the PPP and all the government assistance and everything that came through, the way that Idaho handled everything, we only ended up having to take 10% of those deals on it. In the meantime, everybody's still continuing to pay rent. Again, like everybody up here on the panel was already talking about, the utilization of it is, now that's going to be a completely different story. We're finding that those expansions that maybe took place just right before, they're not utilizing that space, but they're still making those payments. It's opened up a line of communication, I think, a little bit better between the owners and the tenants as well, possibly subleasing it out, or finding maybe a partner that has a different type of business or a different structure of the business they already have to come in and partner with them in their space. We've seen music studios come in with some dojos or, just weird combinations you never think of before to make sure that the payments and stuff are in there. Everybody, again, is being very supportive of everybody in the communication.
You talk about communication, because some of the more successful landlords have figured out a way to use the services of their tenants that are in the building. Like, well, we have, we need a CPA. Why aren't we using someone in our own building? Or we need graphics, and so they're, instead of outsourcing some of these services, they've hired their own tenants and created a partnership, and it's been pretty cool to see. You can do that in a smaller town like Idaho, I think.
Sure.
With ownership, on site and
Well, we certainly saw, across the board, all types of businesses. Certainly Kelly in the retail and restaurant. Idaho wasn't immune to the shutdowns and the slowdown and the different protocols, but it seems though it's back up and running now. Moving forward again, subject to labor. Curious, Michael. You talked about how the market's changed in this area, and we talked a little bit about local investors versus regional and national, and maybe Clay as well on the multifamily side. What's the profile? How is the profile for the investor in Idaho changed in the past
as far
5
as
years?
Investor demand for industrial products?
Sure, and what type of investor? What are they looking for?
Yeah, so just looking at 2021 in a whole, investor demand went up, and I don't know if we're still calling it the Amazon effect or the COVID year, where industrial product is, it's looked at as kind of low risk. Just our vacancy rate is so stinking low, and there's so many quality tenants out there that it's easy to keep these properties full and backfilled, and rents are continuing to go up with such low vacancy. So I see investor demand just continuing to increase as more people get familiar and more comfortable with industrial product. And I'm cheating a little bit. I just got back from Nashville 2 weeks ago. I was at our Colliers national conference, and one of the main talking points discussed was investor demand specific to industrial product. And they said, yes, the larger, more core markets, they're going to continue to prosper, but look for the biggest increase in demand in emerging markets. And that is our market. We're an emerging market. And so I just continue to see investment industrial properties just to be in high demand and just really, really difficult to secure as the competition is deep.
Mike, you have a thought there?
I think what he's talking about has caused cap compression and competition for industrial properties. You know, it was just a few years ago, it's typical to do industrial deals at seven caps. Now we're seeing even sub 6 caps,
Yeah.
you know,
and I know
5 caps
Yeah.
for industrial properties.
Yeah. And I know Mike gets the same calls I do.
Yep.
You know, you get institutional guys, just individuals looking to buy property. They're in California, Seattle, Portland, and they're thinking they're going to sell their 4.5 cap industrial building.
Exactly.
And come and trade into a property here for a 7 cap, and that just doesn't exist anymore.
So Mike, you're a popular figure up here. We've got a question from one of our viewers specific to you saying, do you have an idea of the percentage of industrial buildings being purchased versus leased by the national companies coming to Idaho? Owner users versus tenants?
You know, it's interesting. We're still a market. Idaho is still a market to where businesses want to own their building, so there definitely is a demand for the owner-user type play. But we still significantly outweigh, I mean, investors still significantly outweigh users buying buildings.
Okay.
I'll touch in on the topic of where the capital is too. You think about the trends. Whenever you hear the word Amazon effect, you think how it crushes big box retail, which you always think of big box in a negative connotation. Well, that's the first time I've heard someone refer to big box in an industrial context, which now makes sense. The Amazon effect is helping to expand industrial. Overall, you think about the effect of inflation and what types of real estate can be affected quickest or to benefit from inflation. It's those with short-term leases. So as Scott mentions office, some landlords now are probably more inclined to do shorter leases so they don't get locked into long-term rates at 2% bumps when the inflation runs hard. So that's the first time I've ever seen where a landlord doesn't want, longer term. We just sold a deal in which the buyer was renegotiating the lease in escrow, and they said, hey, this is good news. The tenant only wants to sign a 1-year lease. I thought, and they were excited about the fact that they were signing a 1-year lease. Yeah, and they said, we're excited to renew these guys in a year. So anyway, and then apartments as well. You have just a real-time reaction to inflation, and we've seen a dramatic increase in rents. And that's where you've seen it most prevalent because there's no leases that I know of in the apartment world that are longer than a year. Usually it's, you might get month to month, 6 month, the majority of them are 12 months. And so capital sees that. And so, we've had quite a few publicly traded REITs that are in the market looking on the industrial side, on the apartment side, and then bigger regional players, and that's their angle. It's like, hey, we got to get to product type.
Funny story about, or not so funny for the people that bought this building, but I think it'll turn out well for them. So they bought a fully, a nice Class A office building in the Meridian submarket. It was 100% full. Well, 3 months after buying it, the 75% of the tenants went out due to loss of funding. The value of this building now is $1 million more for what they bought it for when it was fully leased, because it's so expensive for someone to go and build something that we have a product now that an owner user can buy it and occupy it, and the rents that were locked in, we're going to be moving those up by $4 or $5 a square foot. So it's
so
it might
deflated
take
the value.
Yeah,
the previous lease.
The previous lease deflated the value, and so the high costs of construction and tenant improvements and things like that do have its benefits for those that have existing product, right? I mean,
so
the
barrier to entry has changed
the barrier to entry is
significantly
huge.
in our valley
Land
over the last
cost
few years.
and everything. It's and so there are, for every, there's a double-edged sword for a lot of what we're talking about, good and bad, and but for the most part, I think we're headed in a positive direction on the commercial side.
Well, guys, I want to, our director, Amy, is reminding me that we're approaching our time limit here, and she reminded me that if I hit this little refresh button, I'll actually see the questions that have been asked by the audience. So wrapping up here, though, a couple of quick things. Co-working spaces, is this having an impact, Scott, on smaller offices, you know, where you see these, where, you know, you can rent an office for a day or an afternoon?
Yes and no. You know, with a lot of people that have moved here that are working from their home office, it's a nice alternative to be able to step out and say, you know, see kids and, you know, whoever's keeping, you know, at home. But not quite yet. I don't think we're at a point now where that's really impactful. But we'll see.
And then for anybody, a question regarding where you know, within the Treasure Valley, this appears to be specific to, where do you see the most opportunity? What city? Is it Kuna? Is it Meridian? Is it Nampa? Is it Boise? Where do you see the opportunities? And that may change depending on what sector you're in. And of course, I know Mike Pena is going to jump in and say, "Can you?"
Over here. He's so excited about
everything is.
Yeah.
But
I'm going to say Nampa. I just recently did some work on helping a local Toyota dealership expand, and you know, Toyota did a pretty detailed demographic projection of the Treasure Valley, and they felt pretty strongly that Nampa was going to see significant growth more than any other city in the area over the next 10 years. And you look at all the vacant land and some of the natural barriers you have, you know, east of Boise you have a lot of basalt and the foothills and the Boise River. Look at Nampa, and you know, Meridian has the west side sharing with West Boise. Kind of restricted there. So I personally, I think we're going to see most of the growth between Meridian and Nampa. But that's my opinion.
I don't want to step on Mike's toes, but I agree. I agree. Nampa's an exciting market to me. I mean, he mentioned the geographical restrictions we have, so all our growth is going that way from Boise. And then, you know, the more we grow and the more Caldwell takes off, Nampa just continues to become more centralized.
For me, it's probably Meridian is where our growth is headed. But you still can't beat what we have going on downtown. I mean, it is an amazing city where people want to be, and it's, you know, for outsiders who come visit, it's just a really livable city, and to have all those amenities right there. I mean, downtown and Meridian for my money is where offices will be for a very long time and continue to grow. So.
Interesting. Yeah, and just to jump in on retail, I mean, there's still lots of interest in Meridian. There's always interest in downtown Boise. But where we really see those underserved markets in the smaller outlying cities, Star, Middleton, Kuna, those areas, there's a lot of retail interest in those places.
Well, I want to say thanks to the panel. We're going to wrap up here in a moment. Appreciate all of you being part of this and sharing your insights with us. These are the folks, along with the rest of the brokers and property managers at Colliers, that allow us to continue to be #1 in brokerage and #1 in property management in Idaho. I want to thank everybody for attending and viewing today. Reminder that there is a recording of this, and you can tune back into it or reach out to us. Certainly, we just touched on some subjects here today. All of these folks on the panel are available if you want to communicate with them directly to do a little deeper dive into some of the information we've discussed and shared. Also a reminder that, as I mentioned earlier, the Colliers Commercial Real Estate Outlook podcast launches today, and you can find it on Spotify and Google Podcasts. And as we complete another Outlook, it's important to note that next year on October 19th, 2022, we will have our 19th, that's easy to remember, our 19th Outlook conference. So we look forward to seeing everybody there again, and are so appreciative of our sponsors. Once again, Givens Pursley, Land Pro Data, A10 Capital, and Washington Trust Bank are presenting sponsors, along with Crexy, Infinity Signs, Cutting Edge Landscape, ServPro of Boise, Centamark, and Syringa Networks are co-sponsors. They helped us make all this possible. And hopefully everybody hasn't turned off just yet, but I do want to have a special thanks to Amy McKinnon, our Director of Marketing, who puts all this on, and her wonderful team. They've just done a terrific job adapting, going virtual, and giving us this presentation today. So thank you, Amy, and the rest of her group. And with that, we'll say goodbye, and we look forward to seeing you next year.